Good afternoon, everyone. Morning for some, evening for others all over the world. Welcome to today's call. We are about to get started with the trades that we exited last week. We'll start going over those, but before I do want to make I want to make two quick announcements. The first is for those who have talked with Spring in the past. Yeah, however, for whatever reason, you can now text her and you can congratulate her. She just found out she is about to have twins. So she did not give me permission to make that announcement on here, but hey, I'm a proud grandpa, so can't help myself. So text her 918-203-7547 and just tell her congratulations. She is super excited about having twins. I think Mayish, the end of May, I think, is when they were talking about. So super excited about that. All right, back down to business. The other announcement that I want to make is something I've been talking about over the last couple of weeks. If you haven't watched the presentation, I did a live presentation last week on Trade Partner, and that Trade Partner presentation was about how you can own stock in Trade Partner, and that's not available yet, but it is coming. So I wanted to kind of give everybody a heads up on how that was going to work and why we were doing that. I think you'll find it very fascinating. And even if it's only a small amount, you can, if you want to buy $100 worth of Trade Partner, you can buy $100 worth of Trade Partner, and who knows? So we'll see. All right, next. If you are new on the call, I do want to welcome you to this call. However, I do want to warn you that I don't explain everything about these trades on the call. We're going to be going over several trades today. These trades and these calls, these live trade calls, are meant to be attended on a continual basis. So they help as you continue to watch the trades and watch the process of what we look at and how we look at it. That's the way it's designed. It's not designed for somebody to come in here in one call and understand everything. It's practically impossible. So I just want to warn you that if that's what you're expecting, that's not what is going to happen today. I also do want to warn you that these trades are fantastic, but that does not mean that they are the Holy Grail. No such thing exists. These trades are not the Holy Grail. They're fantastic, but they still have risks. And you do have to understand those risks and accept them if you're going to take any trades. So if you're starting off, you need to start small. You need to make sure that you understand what you're doing. You need to follow instructions, and that includes my instruction every week. When I say, if you're going to take a trade, you have to accept the risk associated with that trade, however low or high the probability is associated with that. But starting small, you don't want to be making mistakes with larger trades. Listen, I still make mistakes when I'm placing trades. They're unavoidable when you place, as many trades as I do, and B, just because of the nature of them, there's going to be a mistake made. And I'll show you a mistake that I made today, or not today, but last week. I mentioned it last week. Wasn't a huge mistake, but it's still, one of those things that just kind of makes you angry a little bit that you didn't pay attention enough to do that. But it's going to happen, right? So you don't want to be making mistakes, big mistakes, at the beginning and trading big. You want to start small, and you don't need to start big, because after 6 months, if you start with a one lot of whichever strategy and whichever type of trade you decide to start putting on, if you can average at least $100 a week, and this would be on the non-option insanity trades, by the way. I will make that clarification. But on the non-option insanity trades, if you can average $100 a week, you're talking about growing your account significantly over a 6-month process if you can average just that amount. If you can't average that a week, and some of you won't, if you can't average that a week, then you're talking about, let's say if you only average $20 a week and that's it. you're still talking about growing your account significantly. It's going to take a little bit longer, but you're still talking about beating the best performing stock over the last 6 or 7 years, which was Netflix. So um, the compounding is absolutely critical. If you can get to where you're averaging $100 a week, you're talking about growing your account to as much as $3 million after 5 years. So this is a long term. You're learning this for the long term because long term growth in this is unparalleled. It is unmatched. There's nothing else like it out there. So just go for a small amount every week. Don't get greedy, and then compound it, and you will do better than 99.99% of all traders out there. All right, so let's talk a little bit about the trades last week. I'm not going to spend a lot of time on the trades last week. It was a wild week last week, and as you'll recall, I had exited earlier in the week. I had exited an option insanity trade. This is a 5-1, as you can see. I had exited one for $157, $158. I forget what it was exactly. And then I rolled it. And I rolled it into this one, which was a 377 long versus 387 shorts. And that's what creates this nice big bubble here, this profit bubble. And I did so at a credit of 190. And the previous one, I had a credit of like 212. And the reason I'm doing this particular type is because there's and going out as far as I'm going is because there's a tremendous amount of time value on these. There's about 100 to 125, $150 worth of time value on these alone that you'll see decay in a single week if the market goes nowhere. So I like that fact. And then if the market moves down a little bit, you'll do even better. And then you can just keep rolling, right? So that's what I am trying to do. This week was interesting because this one, which was at a credit of 190 as of Thursday, and some of Friday, the credit got to be quite large. And in fact, let's take a look at where these things are at right now. So I'm going to bring this down before I get to the rest of the trades. So we're going to take a look. Here's the 387, or excuse me, the 377, 387, 5 short 387s. Right now, with the market trading at around 379-ish, it's trading at a credit of 607. So I'm losing about $400 on this trade. And again, this particular trade is not one for smaller account. I do need to clarify that for those that are new on the trade. This is a larger account, and I'm going to talk a little bit about why I place these on, because you can't use money management very efficiently with these trades, but they do add to the overall net in what's called cross compounding. So this is something that you might take a little bit of heat on, but notice, that's a 387. That's the long 387, and this is where that break-even level is pegged at. Look at this. It's pegged at like 389, close to 390 is the break-even level on this. And so because of that, even though we're taking a $600 loss, look, where is this projected to be in 3 weeks when this expires? If the market closes right here at about 400, somewhere around 400 debit, and it's at a $600 credit right now, that's $1,000 swing over the next 3 weeks if the market goes nowhere. If it goes up in 3 weeks, that profit potential is just going to keep going up until it hits about the peak at around 384, 385. Probably not looking at $750, but you might be really close because the volatility will be dropping out of these shorts, the 387 shorts, and so it might hit up to that point. But that's not why I'm holding on to this trade. I'm holding on to this trade for $150 gain, which has not happened yet. I still have, I entered this last Tuesday, so we'll see where it's trading tomorrow. And I'll do a comparison tomorrow as well, or on where it should be in a week. And I think it'll be quite interesting for you guys. All right, so I'll move on to the next trade. And this is the one where I made a mistake in when I entered it. You'll notice here that I had, this is what I call a 1-2 punch core trade. And it's actually a core trade that I'm using specifically for the purpose of putting on risk-free calendars. And the risk-free calendars are basically the end goal with this. And I had put this on, I showed this on my December 17th live trade webinar talking about how to put on risk-free calendars and how to profit stack risk-free calendars. So this is one that I specifically put on as the core trade with the intention of putting on some risk-free calendars. And it was supposed to be a short 2-1-8, long 3-1-11, and short 1-1-8, and I accidentally put in 1-11. So there's my mistake. It wasn't a huge mistake. In last week's call on Monday, you can see it was making $96, and I was in the process of putting on 380 risk-free 380 calendars, and I was only able to put on 2. Right, so I was only I put on 2 of those. And then the market screamed to the upside as the week on went past 380, and we were actually losing, I want to say about $150 on this core trade, but I had 2 380 calendar spreads that were risk-free in addition to this. So on Friday, the market dropped, and I was able to exit this at a break even. This particular spread, during the day on Friday, I just simply had the order working because I had my 2 risk-free calendars. The only reason that I put this on was to put on some risk-free calendars with super limited risk. And so when I was able to get on 2 risk-free calendars, and it became evident that I was not going to be able to put it on anymore because the market had moved up, and it would just be difficult to do that. From that point on, there's no reason to hold this if you can get out. Now, it was at a credit of 210. So if the market was trading at 375, I have no problem, holding on, maybe taking $100 profit or whatever. In fact, I probably should have done this as soon as I realized that I had made a mistake. I probably should have just gotten out and then replaced it with a correct trade. Didn't do that. Ended up breaking even on this. And it was my risk-free calendars that made the money on this particular trade. It was 185 a piece. I just got out at a target of $85 on the risk-free calendars, and had this break-even working as well. So either or, it would have worked. If I would have gotten filled on the 85 or the calendar spreads, but then not filled on my exit of this core trade, then it probably would have been close to about a break even, maybe a little bit better. This is what it looks like with the calendar spread. So if we had gone up to like 382 without me exiting this at a break even, then I may have lost a little bit of money on this particular trade net overall, because this is including the 2 risk-free calendar spreads at 380, the 380 level. Okay. So made 170 on that one. Some would say you got lucky because the market dropped down. No, it has nothing to do with getting lucky. It has to do with getting out. Now, exiting is important here. When I talk about exiting, well, I'm going to wait until we get to this next trade, because the next trade was actually the big one. So I'm going to show you here. This was Thursday's trade. I told you I did a 10 lot on a particular crazy calendar trade, and I did one with a credit spread, and it's really not a credit spread. It's more like short 375, and then the long was just simply a hedge. That's what it was. So I could go bigger, right? So with this one, I ended up getting into this at a buck 12 a piece, and of course I had 10 of them, and then was able to put on 40, so a 4-to-1 ratio, 40 calendar spreads at 23 cents. And on Thursday, with the market trading at like 379, this thing was losing about $1,500. That's $150 a piece. But there's all sorts of time value on these things. So this had like $1 time value per short on the short calendar. And so, basically, if the market would have stayed there on Thursday, it would have been just fine on Friday. But it didn't. The market actually moved higher on Friday, and I was still losing about $1,500 on the trade on Friday, with the market going into 380. A lot of the time value had come out on these short 377s. But then the market came down during the day, and this is where that trade turned into. I made about $1,000 on the trade total. That's $100 a piece because I had a 10 lot. And it looked really bad. And on Thursday's call, as I mentioned, we're trading at 379, and the ratio on the equal movement of the market moving down, so the EMR, it's what I call EMR, a point down is about 2.5. If we drop to 378, which was about a point lower than it was trading on Thursday, about $2,500 on the trade, up to $5,000 on the trade if we move to 377. Well, it actually moved to 377.25 during the day. But when it moved to 377.25, there was still a lot of extrinsic value on these 377 calls, because now they were close to being at the money. And the market was moving, and they were holding their value. But I still had a net, at the time, those were trading at 91 cents. They still had, a net of about, I want to say 75 cents per short when it was trading at 91. On this one, it was actually trading at the time that I was filled on the calendar. So here's what happened. I put a target on the calendars at 85, and that basically gave me, let's see here. It gave me what was I in for? 23 cents. So it gave me $62 profit a piece, right? So that's on a 4-to-1, that's $248. On the short, it was trading at 270, let's say 272. Okay, 272. And I got in at 112, so that gives me a minus about $160. So about 88 cents on that. And that's what I did, is I got out of the calendars first, and then I got out of the core trade at a loss, and ended up making about $88 a piece on that particular trade. Okay, so we went from $1,500 loss with the market basically not moving very much on Thursday to a gain of almost $1,000 on Friday, with the market moving down a little bit. Okay. All right. So that covers the big one, which I know everybody was interested in, and why would it exit. So when this happened, by the way, when this happens, so we moved to 377. I had about $1,000 profit. If the market stayed the same at that point, it would have been fine. I would have made a little more money. If the market would have moved down, I still would have been fine. I would have made more money. But if the market would have moved up, then I would have seen a huge drop. And all of a sudden, the EMR becomes negative. because you have an open position profit, right? So you can't use this graph. You have to use the graph of, okay, how much more profit can I get if the market moves down more or stays the same versus uh, how much I will lose if the market moves back up, and it wouldn't have to move back up very much. And so if you're in a situation like this and you're in a loss, this was in a loss of $150 and the market's already traded past the profit zone because it just screamed up. By the way, the market was trading, I forget where the market was trading at this time. I think it was around 369 when I put this on, and the market just screamed to the upside. And so it already traded past the profit zone. And there is no reason whatsoever. If you're suffering a loss on this thing and then it comes back to a profit on the last day, you know, you should take it. You should absolutely take it. We are doing this to take profits, right? So this is the first time that I actually had a decent profit was during that day. And if I would have stayed in, it would have turned back into a losing trade because the market moved up to about 382. And as you can see, by the time you get to 382, you could be in trouble. So that's, and it didn't quite trade up to 382, but it was getting there pretty close. So um, now take the profits. So on the calendars, the way that I do this is I'll do about 85 to 90 cent target on the calendars. If the market's trading 2 or 3 points below or 2 or 3 points above, then I'm going to place the trade as if the market moved down a little bit or up a little bit towards the peak of the calendar spread. I'm not going to get greedy with it. I'm going to go for 85, 90 cents. And that's pretty high probability on the last day if it comes close to that strike zone. Okay, and the strike zone was 377, right? So if it comes close to the strike zone, hopefully I would be making, 85, or it would be trading 85 to 90 cents. And as you can see, at this particular moment, the market was trading at 377.18, and this was trading at 90 cents. I had put my target in at 85 and was filled, and also put this at a target of 280, and that was filled. And so that was uh, how that worked. If you get out of the calendars, but you don't get out of the core spread, you're still better off. Okay, you are still better off. And why is that? Because if the market moves back up, these calendars are not going to hold their value at 85, 85, 90 cents. They're going to start dropping. And so you're better off just getting out at a peak or very close to the peak, and then trying to get out of the core trade. If the core trade doesn't get out, you're better off. Yes, you'll lose money on the core trade, but you will have taken a significant profit on the calendars, a bigger profit than if the core trade moves back up or the market moves back up and you end up losing money. Now, was a different one because you guys, I talk about doing a core trade where you have much less risk in this, but that's how you would handle it regardless. So most of you guys aren't going to be taking a $150 loss on a single position because you're of how your core trade should be set up, unless you're a little bit more aggressive like I am with these things. All right. So let's segue into some comparisons. Okay, I'm going to take you back to the I'm going to take you back to the 5-to-1 option insanity that I'm in. I'm losing $400 on that thing as of right now. Actually, a little less than $400 now, or no, right at $400 right now. The spread's trading at about 590. A credit 590. I'm in at a credit of 190. But we're trading. We're trading at 379. Let me update where are we trading at. Nah, surely that's not correct. That's got to be an old one. Hang on one second. And you'd think I'd have that right in front of me, but I didn't. Let's see, where is that thing? We're trading at 378.72. Is where we're trading at. So we're just barely over the short of that, and this is where it's at right here. Okay. All right. Now, this is one that expires in basically 3 weeks. It's 111. This one will be done on 129. Okay. So a little less than 3 weeks. In from a credit of 192. What about in 1 week? Okay, this is the 125, 127s. And here's the trade I'm in, 377 to 387. So in 1 week, if the market is trading about here, where we're at right now, we're talking about this trade going down to a credit of 223. Excuse me, 223. Okay. That's $400 in 1 week. That's pure $400 of time value in 1 week. That's how you have to look at it. I don't look at it as, oh no, I'm losing $400 on this trade because it's now trading at 600. I'm looking at it based on what this is going to actually be worth in a week, or in 2 weeks, or in 3 weeks, or however it is, however long it is I'm going to be holding it. And the fact of the matter is that there's absolutely no reason to panic on this thing, being trading at a credit of 592. And on this one, I'll be breaking even if the market's trading at 378. And on this one, if the market's trading at 378, 379 next week at the same time on this same call, then I'm still going to be 10 points away from the break even, which anymore is not that much considering, but the fact that we've moved up so much, there is a bit of a governor going on there. Let's fast forward 1 more week. So in 2 weeks, if the market's trading, however it goes, it's going to up, go down, go up, go down, however it does. If the market's trading the same in 2 weeks, this thing's going to be trading at about a debit of $1.15-ish. That's a debit, not a credit, which means that my 190 credit will be worth a $1.13 debit. That's $300 in profits. If the market goes nowhere, I will turn this $400 loss into a $300 profit in the next 2 weeks, but I'll be out on a target before that. So I'm not necessarily looking at this from the standpoint, okay, it's a 3-week trade. I'm just simply looking at the probability of how fast the market goes up versus how much time is passing. So let's take a look at this one. This is the one that expires this week. How far do we have to go in the money before we see where we're at right now? $600 credit. So let's just scroll down. There's 241, there's 387, there's 560, 762. So here it is, 370, 380. In 2 weeks, if the market's trading at 388, or excuse me, yeah, 388. If the market's trading around 388, then I'll probably be looking at a $6 credit again. But the thing is that there's still, at that point, there's still about close to $600, $700, $800 of time value that would still be on this trade. Okay, so if the market, so this is a 115, 119, right? So I'm projecting myself in the future, a couple of weeks. And I know a lot of you aren't in this type of trade, but the concept and the principle remains the same. This is how I look at trades and what their value is going to be. in a week or 2 weeks if they're 3 weeks out type deal. I do with a lot of these, I usually don't go that far out, but just showing you the principle because it's so prevalent here. All right, so the market can go up, and it can go up to where my short is in the money by basically almost 8 points. Because this short is in the money by 9 points, right? This 370 short right now is in the money by 9 points. Or excuse me, the 370 long is in the money by 9 points. The 380s are still out of the money. Look at the extrinsic value on these 380s. 311. That is huge. That's a huge amount of extrinsic value for being under 380. Okay, the market's trading under 380 right now. So I'm in 5 of these. So if I get to this point and I'm this close to my short, look at how much time value would be. $1,500 of time value on those 380s. So again, this would not scare me at that point. But this is where you have to be willing to. This is why it takes a bigger account to trade this one, because if it absolutely skyrockets and goes super far into the money to where your shorts are 5 points in the money, you're talking about losing about $1,000 on the trade, a little more than $1,000 on that trade at that point. Again, probabilities, especially using an aggressive exit, because if I exit this trade and I go out the next week, I'm going to try and go out a little bit further. Right. So all right, that's the principle behind that one. So now let's turn our attention to what I was talking about with regard to a core trade with the purpose of putting on some calendars. All right, so here, well, actually, let me bring the, let's see, here we go. I'm going to bring this over. And this is a core trade with the purpose of creating 385 risk-free calendars. Okay, 385. So it's short 380, short 2 380s, short 1 385, and then long 3 384s. Okay, this is a core trade. The risk on this trade, if it absolutely skyrockets, is close to about $500, in from a credit of 187. Okay, with the purpose of then, once I put this core trade on, the purpose is to then buy a 385 at the short 387 and create a risk-free calendar. Okay, and so I'd actually be weighted 2 shorts to 3 longs and 1 risk-free calendar. So this is what that would look like as soon as I put on the risk-free calendar. And so now my risk has dropped dramatically. I have at least 1 risk-free calendar on. If I wanted to, at that point, I could exit my core trade at any kind of profit if it came up, if it came about, right? The profit peak on this one is 380. This is not why I'm trading. I'm trading it to put on risk-free calendars. So as soon as I put on that risk-free calendar, I'm going to throw on another short. Let's say it's the 385. Again, it doesn't have to necessarily be the 385. It can be a couple of different ones, depending on where the market is at. But nonetheless, here's my 1 risk-free calendar with my core trade. Okay, so I've got a break even up here at around 385.50, dropping my risk just a little bit. Or since I have, so I start with this one, right? So I start with a 213. If I wanted to, because I have a 187 credit, I could go ahead and just buy 2 of the 87s, and I still have a credit of 13 cents, as you can see. So let me refresh that. There we go. So I still have a credit of 13 cents. Now I have what's called a risk-free projection, although this is a dead zone, so you have to be very careful of that, even though I did drop the longs a bit. But the purpose would be to immediately or at some point add two more or three more. I could actually add three more 385s. So I just go through that process. If I do this, all right, so I can add three more of the 385s and still be equal. So I have 6 shorts and 6, actually that's not true. So let me rephrase that. So it's 5 and 5 at this point. All right, there we go. So there's 5 and 5. And I could, again, add another long and then add another short. And now, so that's with adding another long and then adding another short. So as many times as the market will allow, that's the purpose of doing this. And I'm pushing up this profit zone by adding those risk-free calendars. And again, at any time I can stop putting on the risk-free calendars and I can exit the core trade, let's say at a break even, and I've got all these risk-free calendars, or I can exit the core trade at a profit if the market moves down or if time passes. Okay, now the core trade is really important on this. And the reason it's important is because my core trade is one where time value is going to decrease. All right, so let's take a look at the 122, 125 core trade. So this is the same thing right here, only it's going out an extra week. This is a 382, 387, 386 combination. So this is completely out of the money. Market is trading at 378.67 right now. So this is like almost 3.5 points out of the money. And it's got a credit of $1.98. Right, so that's a huge credit for $1.98 being out of the money. This same one in 1 week, let's say I don't, for whatever reason, I can't put on any risk-free calendars. And if the market stays the same, you will put on a risk-free calendar, at least one. You absolutely will. But if you don't, this is still a decent trade in and of itself, because the 382, 387, 386 call in 1 week is not trading at $1.88, it's trading at $1.20. So you've basically got almost 70 cents of time value in this trade by going an extra week out, right? So this, so this is 122, 122, 125. You're bringing almost $200 credit on the 382, 387, 386, right? But this week's 382, 387, 386 is at $1.20. So it's actually $80 of time value. What are you trying to average? Right, we're trying, if you can get up to $100 average on a week, if you can net $100 an average on a week, you're doing great. So this would provide, in time value, this would provide almost $100 in and of itself in 1 week. Not quite, but close. And you'll notice, what are these 387s going for? They're going for $1.30. So my purpose here is, once this is filled, I'm going to turn around and buy a 387 for $1.30. And so that'll drop my credit down, but I'll have an extra long, and my credit will then be 70 cents. So I'll have this extra long, and the intent will be to sell another 387, 122, and I can do it at $1.30, or I can do it at $1, or whatever the case is, or I could drop it down, and I could, if the market moves down, I could start trying to get into 386s or 385s or 384s, or whatever the case is, as long as you always always maintain a credit. That's what you want to do. You want to maintain a credit. So how are these placed in Trade Partner? And so we're going to take a look at this real quick. We're going to bring one down. I'm actually going to switch this to, I actually got into the this particular one at 188 credit, and I was already able to put on an extra long. I think I got filled at 85 on the long or on the short. So this is going to be a duplicate of that one, but the market's moved down. And so I'm just going to switch this to 122, 122, and 125. All right, so now that's my core trade, and this is a 380, 385, 384. So short 380, short 385, and long 384s. This is trading at a credit of 240. My 385 is at a 180, 187. And so what I would do is I would turn around and I would buy another 385 at 187. As soon as it updates here, it says it's trading at 219, so it would have to move down about 30 cents. This particular call, which it will do, just from the standpoint of time, it will do that, and it will do if the market moves down. If the market moves up, if the market just screams to the upside, then you may not be able to add that third long, which means that you just have this core trade, which is fine because the core trade in and of itself has pretty decent probabilities. Not spectacular, but pretty decent probabilities. You can go way out of the money on this if you want, and create a significant gain. Well, in fact, before I get to the process of this, let's just take a look at this. How far can you go out and bring in about $1 credit? Because you can go 387, 392, 391. Okay, you're bringing 43 cents on the shorts, which means you can. I mean, you could probably have a super high probability of bringing in at least one risk-free calendar on this one in a day or less. But look at this, a credit of 88 cents. That is requiring the market to go way up before you reach the break-even level. You're going to bring in $88. Where is that going to be in 1 week? You take a look at the current 387, 392, 391. Goes from 88 to $23 in 1 week. This is a high probability. That is a high probability trade that you can take $50, $60 in profit on, and it's way out of the money. You can do that in a week. Obviously, if the market moves down, you'll be able to do that quicker. But you can go. I mean, look how far out you can go and bring in $50 a week type deal. Yeah, about $50 a week on that one. Take a look at where the 390s are at right now. 5-cent credit. Okay, you can go in 1 week. This is $57. If market stays the same in 1 week, you're looking at a 5-cent credit, or excuse me, a $52 profit, and you're out in a week type deal. So this is not a bad trade in and of itself to make without doing anything else. Right, you are risking a little bit if the market if the market screams up to 400 in a week, you're gonna be risking a bit on this. Max risk on this would be about $600, a little over $600. But the market would have to scream up to the upside, and there might be all sorts of ample opportunities. Plus, if you've got a 394 here that you're trying to buy for an extra 394 that you're going to buy for 28 cents, if that's the purpose of what you want to do, you want to go ahead and create risk-free calendars at 394, which seems ridiculous, but you never know. The chances of you doing that are super, super high, which means that you would then create a weighted spread. You would have an extra long in place, and your risk would not be $600 at that point. Probability of that happening is just super, super high. Plus, you could put on a hedge, all sorts of stuff at this point. But this is something that it would be really, really super simple for somebody with a $5,000 account to be able to put on. You'd probably want to be a little bit more cautious with the compounding, but it is still a tremendous trade. So you put this on once a week and you compound it 200. Let's see, what would that be? You put this on once a week and compound it at a $200 delta. So after 5 years, and I will do the math real quick for you and tell you what it would be approximately. Almost $500,000. So just this trade alone, compounding fairly slowly, not being aggressive with the compounding at all. And I would personally, I would be aggressive with the compounding. To start with the $5,000 account, you can be aggressive with the compounding if you start with $5,000 on that. And at that point, you're looking at over $1 million after 5 years. Okay. Obviously, the market's not going to stay like this, but if it continues to where it's moving up and you keep going further out of the money and further out of the money and further out of the money, you're doing good. Where does the market have to be for this to be a $57 credit in 1 week as opposed to in 2 weeks when it actually expires, or less than 2 weeks? Well, if you take a look at the current ones, let's see where we go before we hit a 57-cent credit. Look at this. This is a 384, 389, 388. So the market would have to move up about 6 points, and you would still be at about a break even with this trade next week. And it would still be out of the money, by the way, by about 5 or 6 points, because this one is out of the money still by about 5 or 6 points. So you could put this one on, by the way, at a $69 credit, and you're looking at in 5 days, unless the market trades at around 388. It's not going to be. Yeah, it's going to be around 388. That's where that would ended up being a break even or a small loss. All right, so let's get back to how to do this with risk-free calendars, because the risk-free calendars, if you do this and you get to the point where you're putting on risk-free calendars and it's a significant number of risk-free calendars, yeah, it can be pretty lucrative. You can get yourself into a situation where you realize a small windfall in a week. But let's go a little bit further out of the money on this one. So let's go 382. And so the pattern is 4 points between these two shorts. So we'll go 382 and 386. And then the long is 1 point below the highest short. Okay, so it's a 213 and 382, 386, 385. So that's trading at a $1.20 credit. 122, 120. And then we go 3. Oh, I've got that wrong. This should be 5 points, sorry. 5 point difference between the shorts. It's a 4 point difference between the lowest short and the long. So 382, 387, and then long 386s. So that's at a credit of $2 right now. So that's pretty good. So we'll go $2 credit. And we will do 1. So we'll put that in place. And then we will look to buy the 387. I can go ahead and put it at $1.30 if I wanted to. So I would go, if order 1 is filled, place order 2 at a limit of 130, and that's so the market would have to come down 26 cents ish if this was filled, and then I could turn around and buy to open, and I'm going to add an order, sell the 387. That's the 122, right? So I'll do that one. 387, 122, yep. Right there. And 122, 387, it's showing 128. So I would say, so the market would have to come down, right, for the long to hit, and then the market would have to go back up for this short to hit. So I'm going to put it a little bit lower. I'm going to say at a limit, whoops, execute. Can't do 3 things and talk at the same time. So if order 2 is filled, all right, order 2 would be to buy the 387 at $1.30. If order 2 is filled, then execute order 3, and I'm going to say a limit of 120. And what is order 3? It's to resell another 387 call, and I'll do it at 120 because once this is filled, once order 2 is filled at 130, then the market's going to have to go back up in order to get this one filled. And so I'm not going to make it go back up too much. I'll just say 120. And if that is, we'll go this one. If order 3 is filled, then I will execute order, order 2 at 120. So I'm going to rebuy order 2 yet again. Okay. So I don't have to put another order in there. I go order 1, order 2, order 3, and then order 2 again, then order 3 again, then order 2 again, then order 3 again. And I'll do this, I'll look at it. I'll go ahead and push play on this one. But I will ultimately do this so that I look at where the market is in the morning every day, and I reset where I'm going to do it at. Okay. All right. So I'm going to go ahead and turn this one on, you guys. And whoops, not that one. Oh, I didn't save it. I hit the wrong button and I moved off of it and didn't save it. So that's why I don't. That ticks me off. So I'm gonna have to put this thing together again and turn it on after we get off here, which is really, really annoying. All right, so that's what I wanted to focus on today, is a little bit more on that core trade, especially since I made a mistake in the last one. Then the last thing is if I can find it here real quick, I had put on for this week a 375, 379, and then 377 calls as a crazy calendar. And that was before the market shot up, right? So I need to pull that one up and I can't find it. So let me just put it together real quick. So 375, and I'm going to bring this down here in just a second. 375, 379, and then 377 and 377. All right. I did 4 of those. All right, so I basically did this trade at a very small credit. I think it was like 3 cents. And right now, it is trading at a credit of 43 cents. So this is a crazy calendar where we have 375, 379, and then some 377s. And I'm actually making a little bit of money on those calendars right now. What would I do with this? I'm going to hold it. We're at the right end of the risk graph. So let me just put this one up here. Let's see, 115, 115. So 1 second here, and I will put this up here. 375 and 379. And then 4 calendars at 377. 1 second, almost done. 4. And let me bring it over. 115, 115, 119. Whoops. So, oh my goodness. What did I say? 379. Talking and doing this stuff, I swear it's so some of us just are not gifted with that ability. All right, I'm going to refresh it, bring it over, and we'll see where it's at right here. 115, 115, 115, 119, and this says from a 40-cent debit. That is not accurate. That is, we're from a small credit. So it doesn't matter what I put it at as long as I get the credit. All right, we'll just do it at a 0 credit. All right. So let me refresh that. I screwed up the graph and I put, there we go. We're going to change the volatility because that is absolutely not correct. And then refresh it, and then you'll get to see. All right, that's where we are right now. And we're at basically a 40-cent loss with this particular trade. Again, this was put on way back when, so we'll go 383. This was put on back when the market was trading around 367, 368. It had moved up all the way past our profit peak. And so what I'm going to do is anytime that this thing goes back into the profit zone, I am at that point, I'm going to take a profit on this trade. Again, you can do it where you take a profit on the calendars based on the peak. We'll see where we're trading at in a couple of days on Thursday's call, and whether that one breaks in our direction or not. Okay, so the EMR on this is positive right now. So there's no reason to not stay in it. It's not as good as it was when the market was trading at 367, 368 at the time that we put it on, but it is still positive. Okay. All right. So that, I think, covers everything. And that was very good timing for that. So let me see. Let's see if we have any questions. Can I give you a new TPO compounding table? What do you need a new TPO compounding table for? What are you looking for, Mark? So in most instances, the one that we use is perfectly fine as long as you do not, as long as you're not putting yourself at a high probability of realizing a five or $600 loss. Let's see. The current one. Oh, the current one is not very useful, being based on $150 max risk, where the actual max risk is about 500. This is a guideline. So I still use this on my normal crazy calendar trades, where I have, well, this one, the one that we just showed, I still use this one because the probability of going up and actually realizing, I mean, I had a horrible trade, an absolute horrible trade. I can't say a horrible trade. It was a horrible looking trade last Thursday, and it only had $150 open position loss on it. Right. I mean, it was really, it looked bad, right? Which was this one. This is the one that I had $150 open position loss on. The probability of you actually realizing a bigger loss with these safer type of crazy calendars is very, very small. And when I say bigger, you're already maxing out your loss, your max risk on the trade, right? And on this particular one, I think it was $400. So you can use the same one. You just have to understand what the probabilities are of you realizing a bigger risk. Generally, what I want to do, I say max risk here, $150. It's this is with a higher probability of realizing that max risk. All right, if I have a low probability of realizing the $150 max risk level, then I can still use this. It depends on how aggressive you are and how well you're putting on these trades. Yes, so I wouldn't put on the $500 risk trades with $1,000 account, unless it's $1,000 throwaway account. But why only have $1,000 in there if that's the case? Let's see. I'm trading the green calendar and the risk-free calendar stacking. Do I need to manage all positions as one or separately? Also, can these be cross-compounded? Thanks. Yes, these can all be cross-compounded, and you need to manage each of these strategies. So if you're doing crazy calendars and the risk-free as one strategy, then obviously you manage it that way. And that's what I was talking about today. When if you have a core trade on and you've been able to put on some risk-free calendar spreads, if you can get out of that core trade at a break even at that point, then you've got risk-free calendars, and that can be your profit potential. Or if get out at a small gain or whatever, you do not have to hold on to those core trades, so you can manage them that way. Do you know when the spread finder will be released? Let me see here. I just asked about that again before the call because I knew somebody was going to ask. And I we push fixes price opening, so it's better to really stay under. They're saying it's going to be on Wednesday is when they will be able to push that out, and I'm gonna make sure that they commit to that. The portfolio section of PDS Trader has not been retrieving many dates in SPY. Yes, we are aware of that. It is a data issue. It is not an issue on our end. So we have made them aware of it. There is a workaround with that, which I will show you real quick. So for those that don't know, PDS Trader, we rely on our data provider, and the data provider is not updating all of the data. And so if I want to do a 115, 119, I just put some options up in here, and I go in here and I change the date, and then I hit the refresh. All right, and it's going to do it that way. And so everything is, it's not we're not strapped, but we are they are working on the issue, and it has to do with, they changed the way that we get the data, which means that we have to do some altering of the programming, as well as they have an issue. Can you go over calculating the error? Calculating the error. So I assume you're talking about the error. Whoops, that's not the one. I assume you're talking about calculating the error on this trade where I sold the 111 instead of the 18, right? So what's the error on this? Well, on Friday, instead of getting out at a profit on this trade, because the call still had a full weekend and a full day on it, expires today, I had a little bit more extrinsic value on this 380 by about 80 to 85 cents. So instead of getting out of this at a break even, I could have gotten out of this core trade at a small profit. So that was the error. Won't you place a new crazy calendar today? So I just put it in front of you guys. I had to build it again, but that's, hopefully you saw that. How did you figure out the $200 delta on the fly? Just the strike prices? No, once you understand money management, you understand that a higher delta is more conservative and a lower delta is more aggressive. And then you have to, so the max risk on that trade was like $600. The trade that I was talking about, a delta of 200, the max risk on that trade was like $600. But the probability of realizing the max risk on that trade, because it was so far, the market was, it had to go so far up, is that you might suffer once every couple of years type deal, unless you do it wrong. And so I don't want to base my entire money management on that. So if it's $600, technically a conservative delta would be around $300. And so 200, kind of the $100 would be pretty aggressive for that, and the 200 would be right in the middle, is how I determine that. And it's really something that you have to determine based on how much you want to grow and how much you're willing to risk as you're growing, and the probability of realizing those risks. The further out of the money, the lower the probability obviously is of realizing the bigger risk. So again, Mark, it's based on probability, right? What's the probability of you hitting a $500 loss on one of the crazy calendar trades if it's way out of the money? And it's not very high. So the more likely loss is going to be about $150 or thereabouts. And in that case, you're with $150 max loss with a higher probability strategy, this is actually a very conservative growth chart. All right, so this is erring on the conservative when I'm talking about $150 of max risk. Conservative would be a $200 max risk. A slightly more aggressive would be a $300 max risk, and an aggressive would be a $500 max risk. But how aggressive is that depends on the probability of realizing the $500 risk. So it really depends on how far out of the money you go with these. Cayman Islands, Trade-REC will not allow me to open an account. Eric, Cayman Islands. I just had a meeting with the owner of Trade-REC, and I meant to ask that, and I forgot. I'm going to shoot him an email and see if they're any closer on being more lenient with some of those. Mark, no, I'm not backtracking at all. Again, I'm talking about probability. Yes, you do have to be willing to experience the max risk. The question is, how often are you going to experience it? And that depends on how far out of the money you go. If you go way out of the money, so where's the trade that we were looking at here? Let me see if I can't find it. Oh, where did it go? And of course it did. So I don't have it, but the trade where I was talking about this core trade, I start moving windows and it's all over. Once I start moving windows, guys, it's like, there we go. All right, so 2, 3, 1. Let's take a look at this one just real quick. 2 1 3 trade. All right. So I'm gonna click that. All right. So on this one expires this week. It's 380. It's right where the market is. That's the profit peak. It's almost right where the market is. So the probability on this one is not as high. If I were to put on this trade right now, it would have about a $500 risk on it, and that's without assuming that I don't get filled on this extra long, right? Or I don't have let's say I just put this trade on and I'm not even going for an extra long. I'm just putting this trade on, and this is my trade. The probability, the range in this probability is between 385 and 372-ish, 373-ish. That's the high probability range. All right, the max risk on that is going to be, or the risk on that's going to be maybe $100, $150. What's the probability of going to a 500 loss at 390? If I were to do, let me just pull that up real quick, just so that I'm not, guesstimating it in my head. By this Friday, where are you at? There we go. By this Friday, the probability of going to 390 is about 7%. All right, that's where you're going to start getting close to the $500 risk. So yeah, it absolutely can happen. You have to be willing to accept that. Point being is that the probability, though, is that you're not, you're gonna realize it if you don't do anything else. You're gonna realize it 1 out of every maybe 15 trades, and that's probably not quite accurate, even with that, because you're still talking about a pretty big move there in 4 days, right? So it's going to happen, but how much higher will the probability be if this profit peak is at 388 and then you start the descent, right? So I would use a different delta for this trade than I would for a further out of the money trade, is what I'm saying, because of probabilities, even though the max risk would be the same. All right, do you ever envision the MDOP trade becoming available again? Yes, Kat, I do believe it will become available again. But we're going to have to see the market move down and the volatility increase a bit. I will do that one. Okay, the probability of $150 loss on this trade is, if you don't do anything else, is 22%. 22%, Mark. And this particular is a conservative compounding table based on that probability. Okay. So if it's not conservative enough for you, then just change the delta. I mean, you don't need me to give you a new compounding table. Take a look at this one. Switch this to 200. Switch this to a $200 delta. And you go from 2,500 to 27, going from 1 to 2, and then 32 going from 2 to 3. Very, very simple. Also, Performance 1 will allow you to put any delta you want. And so that is, by the way, that's coming out. And if you're a member of the All Access Pass, you're going to get Performance 1 for free. And you can change the delta to whatever it is that you want. All right. Any other questions? I did the trade last week you showed, but shorted 374 instead of 375. Added some 385 calendars on Friday, and it's sitting smack in the middle of the combined profit zone. Well, good luck, John. Hopefully that's what happens. But don't get greedy. If you have a decent profit before Friday, you should consider taking it. So, all right, let's see here. So one, I put together the crazy calendar. Well, actually, you know what? I didn't. So, all right, let's put together a crazy calendar real quick. Let's do. I know I'm already over time, but I answer all questions, as you guys know. So it's y'all's fault. Okay. All right, let's do this. I'm going to do that. We're going to go next week. We're not going to do this week because it's a little bit more risky. You have to go a little bit closer, and you'll see what happened last week when I got close. Still a good trade. Just a little bit higher probability of realizing the risk. All right, let's see here. So we're going to do 322, 321. So let's go 381. Let's do 381, 384, 385 for the bullish, just to see where it's at. And go that. That's trading at a says 140. I don't know if that's accurate. It'll update here. So then we can go 3. I would say 386 to 387 might be the max where I want to go. Let's see here. Let's do a 387. And 387s. Those are going for 31. 26 actually, 26. So that's pretty good. I can actually get 5 of these calendars for this credit. I'm a little bit more bearish over the next couple of weeks, or more neutral bearish, I should say, not bearish, but I'm definitely not as I don't see that there's the probability is that it's going to be as bullish as it has been. It could be, I could be wrong, but you get the idea. So I'm going to do execute order 1. I want to say at a credit of 142, and then I'm going to do if order 1 is filled, I'm going to execute order 2 at a debit of, and I'm going to do 27 cents, and I'm going to do 4 of them, and that's going to give me a significant credit of about 38 cents, 34 cents. And just let me put it in that one, and then I'll turn it on. All right, so everybody see it, 381, 384, 385. So this is an MDOP 1, bearish neutral 1. And the risk on this is 500 minus 148, so 350 on that one. And then I'm going to add the 4 trades, so 450 max risk. And that 450 max risk is not going to happen until you get to about 395-ish. All right, so pretty high probability trade. And so I'll just go ahead and turn it on. And I just picked one at random. I didn't look to see how far I could go, to where I could get an exact credit. I didn't throw any risk graph on there, et cetera, et cetera. You just have to know how the more you do this, the more you know how it works. Obviously, the best thing to do would be to go in here and say, okay, I can do, I can do the 3 strikes higher than what I just showed. And so 3 strikes higher, let me put that back here, with everything, and still bring in a small credit, let's say a 2-cent credit. So I can go 384, 388, 389, and then use 390s or 391s for the calendars, and I can still bring in a 2-cent credit. So if you want to go way far out that way, then you'll have a high probability. You're talking about a super high probability trade there. But you're not going to make a lot if the market moves down. Okay. All right. I will leave that one up for a second. We're going to find out how to calculate probabilities. Lawrence, the dirty way to do it, the fast and dirty way to do it is just to look at the delta of the break-even strike. So, for example, where's that one? You guys had me moving windows again. All right, there it is. All right, so for example, the break-even level on this trade right here is projected to be about 383, and that's if the volatility doesn't collapse more than what it shows. But if it remains there, then you look at the delta of the 383 that expires this Friday, which would be on the 15th. And that one is 25%. So this has a 75% probability of success. And then 187. So let's say 187 is a credit. Where would we lose 187? And it would be at about 386, and the probability of the market going up to 386 is 13%. So there you have it. And that's just a rough, I mean, obviously you have to, you have to understand what probabilities are. Does it make sense to play both crazy calendars and risk-free calendars together, both at the same week? Yeah, I do, but I make sure I separate what I'm trying to do with them. All right, looks like I've gotten all of the questions. A lot of money management questions. I would suggest going through the course again, and just it doesn't hurt going through that course once a year, just to keep tip-top shape. The more you understand the money management, the more accurate you're going to be able to apply it to your circumstances, your account value, the strategy that you're trading, the probabilities that you're trading, and obviously your risk tolerance levels and your goals. All right. Oh, yep. I will pull that trade back in here. Whoops. So 381, 384. Yep. All right. So that one is working. I believe it was filled, and I don't know why that didn't show up. Let me see if it does. All right, so I am filled on the core trade. I am not filled on the calendars yet. So I'll just let them sit, and I'll take a look at that again before the end of the day. All right, everyone. Have a wonderful day, and I will see you on Monday.